Good day. In this lecture, we are going to talk about banking regulation. Let's try to, first of all, to understand the reasons for banking regulation. Why banks have to be regulated? Why banks are regulated worldwide? Well, first of all, the first idea is that the banking system, by definition, is intrinsically fragile because it is based on banks are they, as we said in module one, banks collect funds short term, they lend money longer term, and therefore they are exposed to bank run, to the fact that a large amount of depositors can may decide to withdraw the money at the same time, and therefore banks does not have enough liquidity. So one key idea is that banks have to be regulated in order to ensure that they have enough liquidity in order to repay depositors, because depositors are economic agents who are less informed, and therefore they don't have all the tools in order to actually understand the risk of dealing with a bank. Second, banks regulators, they have to verify that banks they do not take too much risk, or at least if they want to take risk because they are firms in a competitive market, they must have in place tools in order to measure those risks, in order to manage those risks. So the presence of systemic risk is a second key driver of banking regulation, financial regulation. And as I said, protection of depositors is another very important reason why banks have to be regulated. Regulation had a very significant development in the last 20 to 30 years, because till the 1980s, before Basel I Accord, which occurred in 1988, only regulation was relatively heterogeneous, banking regulation, but Basel I, which has been signed in 1988, was the first effort in order to have some common standards for regulation of banks in the US, in Canada, in Japan, and in Europe. So the banking regulation is a form of government regulation which subject banks to certain requirements, but also restrictions and guidelines, and all those are designed in order to create market transparency between banking institutions and individuals and corporations with whom they conduct business, among other things. So the idea, the rationale of banking regulation is that banks are not totally free to run their businesses in the way they want, but they have to ensure that they do not take too much risk. They offer their clients products and services which are in line with the preference and the risk appetite of clients, and so on and so forth. The objectives of banking regulation are several. We have a prudential regulation, which is the most relevant one, and it is based on the fact that banks can run a business, but they must ensure that they have enough capital, enough liquidity in order to face unexpected negative events. Second goal of banking regulation is to reduce systemic risk, to ensure that banks are not too much affected by a limited number of risk factors. Also, another rationale for regulation is to avoid the misuse of banks. So regulators want to be sure that banks are not used for money laundering purposes or for financing terrorism, for instance. And also, regulators are interested to verify that banks are allocating credits properly. So they are, for instance, not concentrating credit portfolio in a small number of counterparties or in a small number of industries. But the idea is that credits should be properly allocated in a diversified manner, and to those counterparties who have a genuine capability to repay loans. So regulators verify that banks have proper practices, procedures in order to allocate credits towards those counterparties who have the capability to repay loans. And also, more recently, regulation includes some rules and which are addressed to ensure that banks are treating customers fairly and they have a corporate social responsibility. So in essence, in the last, let's say 20 years, regulation is more and more addressed to ensure that banks they do not screw their clients, they treat them fairly. So regulation should, at the end of the day, prevent bank failures, should be there. Regulators and supervisors are there in order to prevent bank failures. They should monitor and ensure that banks are mitigating risk, are managing risk properly, and also that the corporate governance is appropriate. So banks, regulators, they verify that the way banks are managed are okay. The Basel Committee on Banking Supervision is a committee of banking supervisory authorities that was established in the central bank governors of the group of 10 countries in 1974. So the Basel Committee is a club of regulators which exists since 1974, and the members of the Basel Committee include organizations with direct banking supervisory authority and central banks. Nowadays, we have 45 members from 28 different jurisdictions. We have to say that many other countries worldwide decided to adopt Basel regulation, even if they are not part of the Basel Committee on Banking Supervision. So the objective of the Basel Committee is to enhance understanding of key supervisory issues and improve the quality of banking supervision worldwide. What are the most relevant Basel Committee activities? Well, first of all, the Basel Committee is a forum which makes possible to exchange information on developments in the banking sector and financial markets. So it is the Bank for International Settlement, which operates as the secretariat of the Basel Committee, and it is based in Switzerland and in the city of Basel. In the Basel Committee, different regulatory authorities, they share information about banking sector and financial markets. They also share supervisory issues and also approaches and techniques. So it's a place where different authorities discuss about the way they can regulate and supervise financial markets and financial institutions. In the Basel Committee, authorities establish and promote global standards for regulation and supervision of banks, and also guidelines and sound practices. So in the Basel Committee, different authorities, they promote global standards for regulation and supervision, and they discuss about guidelines and sound practices that all the authorities and all the banks have to implement worldwide. They address regulatory and supervisory gaps. They consult with the central banks and authorities which are not members of the Basel Committee in order to benefit from their input into the Basel Committee. And they monitor the implementation of Basel Committee standards in member countries and beyond. And last, the Basel Committee coordinates and cooperates with other financial sector standard setters and international bodies, like for instance, those in charge of regulating and supervising insurance companies or financial markets, for instance.